All right. Well, we're back for the weekly rebalance. Welcome back. Hey Nick, how you doing?
Doing well. How about you?
Pretty good. Can't complain. Little
Good.
little tired today, but other than that, pretty good.
Yeah, there you go. I get it. Election day here in Virginia, so had to run out and vote today.
Yeah. Sounds
Yep.
good. We had the time change now, post Halloween. It's yeah, it's beginning to look a lot like winter,
I know.
fall at least.
When it was dark yesterday at about 5:30, I was a little bothered by that.
Yeah, yeah, it's same. It's getting, I think the sunset time today is like 5:06 or something. Let's see. No, 5:18. 5:18. It's getting pretty early. I did notice it was kind of funny. Yesterday was the first I was out shopping a little bit yesterday. Not for any Christmas, just random errands I had to run. And I noticed for the first time I was in a Home Depot, Christmas trees everywhere. They're playing Christmas music. I was in like a Hobby Lobby, Christmas music just like blaring. I'm
I
like,
mean, a
wow,
Hobby Lobby, they're like Christmas year round, I feel like.
that's true. That's true. Yeah, that yesterday was the first day where I was like, wow, it's Chris. Apparently Halloween flips over and it is Christmas time.
Yeah. Yeah, that is
Didn't used to
funny.
be like that.
Yeah, I don't know. That would be an interesting thing to see how that's been moving up. I feel like people have been complaining about that since like the 70s.
Yeah,
Keeps
man.
on moving up and up and up.
Yeah.
I think there was some sitcom I was watching where they were complaining about it like back in 1980, and I was like, how has it been progressively like moving earlier
Yeah.
in the year since then, and it's still like around Thanksgiving? Like you'd think we full circle by now, but that's what
Yeah.
everyone says.
For whatever reason, I feel like when I was a kid, it was the day after Thanksgiving. That's when everybody got into it. But
Yeah, I think that's the rule
maybe
of
I'm
thumb.
wrong.
I think that's the acceptable rule of thumb.
Yeah. But some people, I mean, they started advertising putting Christmas lights up in like August here in my neighborhood. I'm like, it's
Yeah.
90 degrees and we're putting up Christmas lights.
I get it. I mean, depending on where you're at, I like Christmas lights. I think they look good year round.
Yeah.
Why take them down?
Yeah. Just leave them
Just
up.
just leave
Well,
them.
these companies, they advertise putting up your Christmas lights now, which I don't know, maybe I am just misremembering this, but when I was a kid, that just wasn't a thing. You would do it yourself. And so I would get out there with my brother, my dad, and we'd, hang the lights on the trees outside and stuff like that. And that was our job. But apparently now you can do that. And I called one of them because I was curious last Christmas or maybe two Christmases ago. They were going to charge me like $500 to put them up.
It's not cheap. I have a buddy who actually he has a local pressure washing business, and
Yeah.
he uh purchased, I believe he purchased a Christmas lighting company where
Yeah.
they go around and do Christmas lights and stuff like that. And yeah, it seems like it's taken off for him. So
Yeah.
there's definitely money to be made there.
Yeah. Yeah. Well, the jobs market may be slowing down, but not for Christmas light installers.
Yeah, that was a rough transfer, but I like it. I like it.
Did you like my segue there? Yeah, that was cheesy. I apologize for that.
Oh man.
I sincerely apologize. I'm not known to be smooth, so that's the best I could do, Nick.
Oh man.
Oh, geez. Well, yeah, that was the interesting commentary from the last week, right? Was really the Fed. We talked about it quite a bit last week. More just talked about it and anticipating what was happening last week. I think the big surprise was the I guess a lack of foregone conclusion on an additional rate cut here in the last part of the year. Everyone was kind of predicting the futures market was predicting that we were going to have a cut in November, which we got, right?
Yeah.
And then another one in December was foregone conclusion, but that's not true anymore.
Yeah, that was definitely the biggest surprise to me listening to the conference. Especially, I think there was one particular part of the meeting where he had some comment that made it seem like they were leaning towards potentially no on the cut, or that was at least something that they were heavily considering. And just his wording was like a little bit funny and interesting.
Yeah.
So I definitely found that interesting. Last week we were looking at the FedWatch tool, the CME FedWatch tool, and I remember seeing that at the meeting following the one that we had last week, it was almost certain, according to the futures markets, that we were going to get another rate cut at the next meeting, but swiftly pulled back after that meeting. To
Yes.
it's still. Let's take a look. Let's take a look here and see where we're at for the next meeting,
Is
because
this,
it had
you're
pulled
looking at the
back from
percentage
high
chance?
90s. Yeah,
Yeah, it was like in the 90 plus.
yeah, we went
I'm
from
gonna
high 90s to now we are sitting at
I'm gonna guess
70%.
60. Oh, I was gonna guess 60. 70 is where it's
70.
at.
And I looked at it last week too, and it's kept on pulling back. Last week we were somewhere around 88. So just interesting to see how the market's digesting that. Certainly seems like
Yeah,
it's playing out in the futures market in terms of expectations, but
right. Well, we're starting to have some internal divisions there with the Fed. That there were what two dissenters, I think.
mhm.
Um,
One
yeah,
for and
two.
one, yeah, one for and one against.
Yeah, one for and one against. That's yeah. Well, a lot of interesting data or information, not less data, more information, just coming from the Fed, coming from the conversations coming out of that meeting. So yeah, a lot to see there. It's always, I don't know, the jobs market's the concern, right? They seem to be very unconcerned about inflation. Inflation has obviously come down. It's not where they want it to be, but we did get some, the last number of CPI prints were, modest month over month pace, nothing to be concerned about. So whether that continues or not is the big question, right? Maybe it's too easy to focus on what happened in 2022 and not and overcompensate for that risk. But that's what the Fed is saying. The Fed is projecting that inflation is going to get down to 20, the 2% target by 2027. I mean, that's longer. That's still years away. So again, that we're trying to hitting a moving target many years in the future is obviously difficult. But they're more concerned about the jobs market now than anything else.
Yeah, it certainly seems that way. And it's definitely just there's added difficulty just with the lack of data coming out with the government shutdown, or the significant delay in data as well. So,
Right.
yeah, I think it was wise for them to leave the door open to a lack of a cut at the next meeting, just given there's a lot of data that could come out that could swing them one way or the other. And with the amount of certainty that the market was pricing in a rate cut at the next Fed meeting, it's probably wise to temper those expectations.
Right.
But
Absolutely. Well, it leaves you questioning where are we at in the business cycle, which is the big question, right? Where are we at? Um, we at the end, the beginning, the middle. I think we're not in the beginning. I think everybody knows that.
yeah,
But yeah, interesting. Uh, the $1 million question. I know you did a little bit of work on that this week as well. What did you find in that realm?
yeah, I did a little bit of work on that front, and you know, it gives us at least some insight into an answer, but it's not necessarily the exciting one or anything like that.
Right.
Just kind of, in lines with what you might expect. And basically, taking a look at this, and this ties into studying for um, CFA. I was doing
Yeah.
some reading earlier this week, and we've been talking about where we're at in the business cycle. And I was doing some reading on basically just credit spreads and how they can indicate where we're at in the market cycle, and wanted to do a little bit of a deep dive into where we're at right now. And so went on ahead and ran this off in Bloomberg today. And then this blue line up here, this is the yield curve for single B bonds, so B plus, B, and B negative, which for all intents and purposes, we're just using that as a proxy for high yield, since that's outside of
Right.
the investment grade spectrum. And
Mm-hmm.
then down here, we've got the US corporate investment grade yield curve down below here. So typically, how these lines or these yield curves, how they are positioned relative to each other, can give us some insight into where we're at in the business cycle. And basically, doing some analysis and taking a look at these charts here, essentially coming to the conclusion that we're either in late expansion or towards the peak of the business cycle, just because typically we have high yields and investment grade yields moving similar to each other, just obviously having a higher spread for the high yield bonds, which we would expect to be present in pretty much any condition, just given that you're taking on additional credit risk.
Right.
So, given that we see that these lines are relatively parallel, or the yield curves between these two segments of the fixed income market are relatively parallel, that tends to indicate that we're somewhere towards peak or late expansion within the business cycle. So I don't think that's going to come as news to anybody. There's no like shocking forward-looking indicator that we're uncovering here or anything like that. But this at least seems consistent with this thesis that we're at the peak of the business cycle or coming to the peak of the business cycle.
Yeah.
I know that there's been some interesting work done projecting that we had a recession, earlier this year. Um, and there's a lot of interesting data to support that. Just this particular metric here seems to indicate we're late expansion or at the peak.
Yeah.
And I took a look back because I thought we might find some interesting data if we took back a look back to Liberation Day or right after Liberation Day, so April of this year. And we got a little bit closer to a contraction. And basically, what you would expect to see with that is you would expect to see the high yield curve inverted, while the investment grade curve is a little bit more flat or also slightly inverted. And we got closer to that kind of relationship here at Liberation Day, but not really there. Certainly the curves moved to being more flat across the board, but didn't get that signature inversion that we're really looking for with that. So got close
Right.
with Liberation Day. That was kind of a short-lived market reaction too, though. So maybe it just didn't get the chance to play out, that sort of thing. Taking a look at a year ago, kind of a similar story, late expansion peak relationship that
Yeah.
we're seeing between these two curves here.
I don't know that. Yeah, exactly. And that shouldn't really be surprising to anybody that we're late expansion peak. I think that, again, one of the things that we did in our portfolios this year was actually eliminate the high yield exposure because, again, credit spreads in general, oh, there you go, have
Yeah.
gotten very, very tight recently, which, don't want to be in high yield when things are very tight. The chance that those spreads blow out and go up quite a bit and you have a big loss or a big sell-off in high yield is very high, which again typically is going to correlate to a risk-off sentiment, a market sell-off, or some type of correction, whether it be a mini correction, something like 10 to 20%, or something larger. So, good reason to again, all of this being said, the point being that there are a number of risks out there right now, highlighted by the Fed, their concern in the jobs market, highlighted by the items that you just pointed out, Nick, that were late in the business cycle, the valuations in markets, especially in these tech growth names, and things like the high yield spreads are indicative of there's some risk out there, and it's a good time to make sure that you're fully and properly diversified. Otherwise, you run the risk of having an event that you may not want to go through.
Yeah, absolutely. And I think that's kind of the funny thing with credit spreads, especially particularly now what we're seeing just right now it's reflecting that there's relatively low risk out there. Spreads are low historically, getting close to the lowest that we've seen over the past 25, 30 years here. But that's like point in time data. You can see
Yeah.
that spreads move really quick as soon as there
Yes.
starts to be disturbance in the market. So I think that's kind of the funny thing. There's a lot of like suspicion that there's a good amount of risk out there. We just haven't really seen it play out aside from Liberation Day. And
Right.
that was short lived, and it was kind of just a shock to the market that we're going to have high tariffs, much higher than we're anticipated. So
Right.
um, I think there's just a sentiment out there that things might change, and we'll have a lot more risk in the market. So I find it a little bit funny that this number hasn't started to creep up a little bit, just
Yeah.
given. I don't know. It just doesn't seem like a very attractive time to hold high yield. I mean, maybe as a yield enhancer, um, but I'm a little bit surprised that it's at the level that it is right now.
Yeah. Yeah. Yeah, for sure. As it starts to yeah, price in some of those additional risks. But like you said, it can happen quickly. So we'll see. I mean, again, that's not to be cliche, but that is the obvious reason for diversification and rebalancing. And that's one of those things. Rebalancing, we've talked about this a number of times before, I think even on this podcast, but one of the big things with rebalancing that I think is a misnomer is rebalancing is some type of return enhancer. Now, the buy low, sell high is, I guess, accomplished in rebalancing, but most of the time, the bigger element to a rebalance is taking items that have sold off. Usually, you're talking about an equity and fixed income, an aggressive and a conservative asset, and you're talking about selling off the aggressive asset and moving into the more conservative asset. And in a market like we're in now, after we've had many years of, positive growth, especially the last 3 years, the again, that is a risk control more than it is a return enhancer. If you think about it, if you were to never rebalance and you start with a 50-50 portfolio, 50% stocks, 50% bonds, and you never rebalance, you'll eventually be 60% equity, 70% equity, 80% equity, etc. If you just assume that the average growth rate for stocks is about double, if not even more than that, for stocks versus bonds, you end up with more and more aggressive assets, and your expected rate of return long term goes up, but your risk goes up. And rebalancing back to your number 50-50, 60-40, whatever, again, it's a risk control. So if that's important to you, if it's important to put risk controls on your portfolios, which in most cases, most advisors, most clients, that's a big part of our job. Again, rebalancing, diversifying, having different asset classes so that you can rebalance and control your risk is extremely important. And now is a great time to do that. Um, Especially with the market we're in and the last number of years that have really been a major run for many equity asset classes, most
Certainly.
equity asset classes.
Yeah, absolutely.
So yeah, just a good reminder. I mean, that's not rocket science, but it really is extremely important. It's easy to lose that discipline right at the worst time. So, I, for me, I think encouraging that type of behavior is extremely valuable at this time, even though it's not exciting and you know the next hot thing to talk about, but it's really valuable.
Absolutely. Yeah, it's really tough when momentum has just crushed it as a factor compared to most anything else. Uh,
Right.
does make it difficult.
Yeah, it certainly does, but it is nonetheless valuable, if not even most valuable at those times. So we're going to continue to do that. We we typically, I mean, what would you say is the the most typical time that you would, or most typical cadence that you see most portfolio managers and advisors liking to rebalance and put those risk controls on? Quarterly, monthly, semi-annually? What would you say?
Well, of course, in keeping with the nature of our podcast, I would encourage weekly rebalancing. But no,
That's right.
actually, at working on the trading side of things, we both have done a decent amount of global rebalancing trading. Please don't do weekly rebalancing.
Don't weekly rebalance.
Aside from with us, this weekly rebalance. No, I think it's most common to see quarterly. Quarterly is very common. In terms of a true rebalance. So we're not necessarily reconstituting the portfolio. And then I think it's pretty common to see quarterly rebalancing with a yearly reconstitution. So revisiting the
Yeah.
positions and the weightings once a year, but then we're rebalancing to those new targets that we set at the beginning of the year. Pick whatever part of the year you want to do your reconstitution, but
Yeah.
rebalancing to those targets every quarter.
Yeah, absolutely. And another nice feature that you can easily do is uh once a quarter. I mean, you have all these dividends and interest they pay into the account. And whether it be ETFs, individual bonds, equities, you have dividends, interest, they build up. Take that, and well, what we do at Revisor is we do what we call a buy only rebalance, and we just invest the cash towards the targets, and it'll just buy the most underweight position, and go from there. And that's another great way to kind of keep things in check and keep cash low as well. But yeah, I think that you're totally right there. Something like a quarterly rebalance is really very logical. Keeps things under control and allows for those risk controls to do their proper jobs.
Yeah, absolutely. And actually, I think that brings up an interesting point. You're talking about reinvesting dividends. We get this question a lot from our advisors as to how we set up our dividend reinvestment, because it's different than just turning on dividend reinvestment at Schwab or whichever custodian that you use, because it's going to take those dividends from the specific position that pays them out and put them back into that position again, which really can mean that you're drifting further and further away from your target weight
Mm-hmm.
because you're just adding to these positions that are paying dividends. So particularly if your fixed income is paying a particularly high yield, you can end up leaning more and more into fixed income, those sort of things. So doing a buy only rebalance where we're buying the underweight positions with those dividends that are coming in really gets us to target more efficiently, and it gets the cash deployed in a manner that's more consistent with your model than if you were to do just traditional dividend reinvestment plans.
Yes, absolutely. The other thing is dividend reinvestment. If you have a bunch of stocks or ETFs or whatever, and you have the dividend reinvestment turn on and they're buying these partial shares in taxable accounts, that's incredible. That's, in my opinion, very tax inefficient because it creates this, every position now has this issue of wash sales
Yep.
because you've effectively had a buy on every single position. So having more control over that and just having it pay to cash and then being able to actually use that cash to rebalance towards underweight positions gives you much more control there and eliminates a lot of the issues that are caused by dividend reinvestment programs. It's nice that you can have the dividend reinvestment on if you were just to never touch your portfolio again. That way you don't build up a bunch of cash, but that's not what we're doing here. What you would assume is that a professional portfolio manager and advisor is going to be managing managing that cash properly and putting it towards the right positions. So yeah, that's another common pitfall I think I see people do is they turn on dividend reinvestment because it's easy. And in
Yep.
reality, especially in taxable accounts, it's really inefficient and creates a lot of problems.
Yeah, absolutely. I mean, not to mention, we kind of see the back end of things, particularly on the trading side, with when you have those partial shares at a custodian that does not support trading in partial shares outside of
Yes.
liquidations, it creates a lot of problems. So that's not really the main concern that you should have when you're doing anything like that, but it can add to your operational complexity if you're doing something like that and have a bunch of partial shares.
Yeah. very much so. So
Yeah. I'm just
good point.
sharing all of the secrets on the back end about how we
Yeah,
don't like to actually rebalance weekly from a trading perspective, not from an informational perspective like we're doing here.
that's right. That's funny.
Nah, there's definitely a case for that. It's just it's a lot of work to do all of that, run all of those rebalances and keep everything.
Yeah, absolutely.
Doesn't like that, but
No, very good. Well, what else? Do you have anything else for this week, Nick, or is that all we've got for this week?
I don't think I have anything else serious, but I do have another trivia question for you. If you want to do it,
Sounds
if you want
good.
to do a trivia question.
I would love to do it too. I don't have one for you this week. I'm sorry.
Ugh, that's all right.
I apologize. I've let you
That's
down.
okay. That's okay. Nah. All right, perfect. Here we go. Here we go. When was the New York Stock Exchange founded? What year? I'll take the year.
Hmm. When was it founded? 18. Am I right on the century?
No.
No?
No.
17?
Yeah.
1796.
That was close. 1792.
Oh, okay.
24 stockbrokers signed the Buttonwood Agreement
Interesting.
on Wall Street in New
1790.
York City.
Imagine, I wonder what the companies listed were.
Yeah, it would
Are
be.
any of them still around?
It's a good question. Let's see. Let's do a quick question.
I would bet you not.
1992 still around. Probably not, at least in their original form.
Yeah, definitely not in their original form. Wonder if any semblance.
Oh, Bank of New York,
Wow, there you go.
now known as BNY Mellon,
Huh,
founded by Alexander Hamilton in 1784.
interesting.
Very interesting.
There you go. So is that the oldest publicly traded company, at least in the United States?
At least on the New York Stock Exchange, it appears that way. I don't know. There might be
Might be something else somewhere.
something else somewhere. This is
Very
all
interesting.
we're just learning as we go here.
Yeah. 1792.
Yeah, I think so. It looks like Bank of New York was founded in 1784, chartered in 1791. So actually, probably a little bit before that. I guess it was just a formalized exchange was 1792.
Huh, interesting. Very neat.
Okay,
Well, that's a
yep,
good.
that is. It says oldest publicly traded stock in the U.S. BNY
Well,
Mellon.
now we know. That's interesting. That's good trivia there.
There you go. Yeah,
Good
I came
trivia.
prepared.
Unlike me.
Exactly.
Yeah.
Exactly.
Awesome. Well, I think that wraps it up for us this week. So we'll be back next week, same time, same place.
All right. Bye, everyone.
Thanks, Nick.